Imagine for a moment that you wake up tomorrow morning, check your bank balance, and suddenly discover that you have exactly $500,000 sitting in your account. Now, your very first reaction probably wouldn't be a feeling of pure confidence. In fact, it would likely be the opposite: hesitation, and perhaps even a significant amount of anxiety. When faced with a sudden windfall like this, most people tend to fall into one of three traps. They either rush impulsively into an investment they don't understand, they try to get clever and outsmart the market, or they simply scatter the money around randomly with no cohesive plan, just hoping it all works out. John felt this exact same tension. It wasn't because $500,000 isn't a life-changing amount of money, because it absolutely is. It was because having big money tends to magnify even the smallest mistakes. So, instead of guessing blindly or paralyzing himself by overthinking, John makes one definitive choice. He takes that entire $500,000, allocates it into the top 5 best Fidelity Index Funds, and then proceeds to do the single hardest thing in the world of investing. He does absolutely nothing. In this video, I am going to walk you through exactly what that journey looks like for John. We are going to explore how each specific type of fund grows over time, how dividend payments start off incredibly small before stacking on top of themselves, and why the process of compounding feels painfully slow in the beginning before it eventually takes over and does the majority of the heavy lifting for you. Along the way, I will reveal which specific fund ends up paying John an income of over $45,000 every single month. And by the very end of this breakdown, I will show you the one single fund that has the potential to turn John's initial $500,000 investment into a massive portfolio worth more than $47 million. The power of compounding. Before we even look at the first fund on our list, there is one fundamental concept that John has to understand, because without grasping this, none of the numbers we discuss later will make any sense at all. This concept is the very reason why long-term investing works in the first place: compounding. Most people hear the word compounding and they think it is just a dry mathematical formula. In reality, however, it functions much more like momentum. At the very beginning, it seems like absolutely nothing is happening. Progress feels incredibly slow, and sometimes it even feels pointless. That feeling is exactly why so many people quit investing way too early. Here's a simple way to visualize it. Imagine you start with $100,000 and you grow it at a rate of 10% per year. In year 1, you earn $10,000, bringing your balance to $110,000. In year 2, that same 10% return now applies to the $110,000, which adds $11,000, pushing the portfolio up to $121,000. In year 3, that 10% adds $12,100, bringing the total to $133,100. Nothing changed in the math except that the base got bigger. Each year, the exact same percentage produces more actual dollars because the previous gains stayed invested. That is compounding in its simplest form, and it is the engine behind every long-term result you are about to see. Dividends add another layer to this process. A small payout doesn't feel life-changing on its own, but when dividends are reinvested, they buy more shares, which then produce their own growth and their own future dividends. Over time, those small additions compound right alongside the price appreciation. Index funds are built for this exact process. When companies grow, they naturally become a bigger part of the index. When other companies fall behind, their influence automatically shrinks. There is no need for you to constantly make decisions or guess which stock is next. You simply stay aligned with the long-term winners as the market evolves. On top of that, index funds have super low fees, which is exactly what John is looking for. Instead of trying to pick winners, he owns the entire system through index funds and lets time do the heavy lifting. With that in mind, let's start at the bottom of the list and work our way up. Fund number 5, Fidelity Midcap Index Fund. Beginning with number 5, we have the Fidelity Midcap Index Fund, or FSMDX for short. This index fund sits right in the middle of the market. It invests in mid-sized US companies that are past the risky startup phase, but have not yet become massive corporations. These are businesses that are already established, making real money, and still have significant room to grow. That balance is what makes mid-cap investing so appealing for long-term growth without taking on extreme risks. FSMDX holds 815 different companies, which gives it strong diversification right out of the gate. What really stands out is how evenly spread that exposure is. The top 10 holdings make up just over 6% of the entire fund. That means no single company has the power to drag the whole portfolio down or push it up on its own. Performance comes from the broader strength of the mid-cap market, not from betting on a few big names. The sector mix is also well balanced across the economy. Industrials account for 17.17%. Technology makes up 15.8%. Financials sit at 13.54%. Consumer cyclical is at 12.02%. Healthcare is 9.88%. Real estate comes in at 7.16%. The rest is spread across utilities, energy, communication services, and basic materials. This kind of balance helps reduce risk across market cycles because different sectors tend to perform well at different times. Looking at performance, FSMDX shows steady long-term growth with normal ups and downs along the way. Over the last year, the fund gained 9.77%. Over 5 years, total growth was 38.78%. Over 10 years, the fund delivered a total return of 129.35%. These numbers reflect its role as a long-term growth fund, not something designed for short-term trading. Another major advantage is cost. FSMDX has an expense ratio of just 0.03%. That may sound small, but over the decades, it matters immensely. Less money going to fees means more money staying invested and compounding year after year. From a risk standpoint, the fund stays disciplined. Portfolio turnover is 15%, which reflects moderate rebalancing, consistent with an index fund that helps limit unnecessary trading costs. On the technical side, the long-term trend is still healthy. The 10-day simple moving average is 37.52, and the current price is 23% below that level, which simply points to normal short-term consolidation. At the same time, the fund is 1.23% above the 50-day moving average of 36.98 and 6.04% above the 200-day moving average of 35.3. In plain terms, there is some short-term noise, but the bigger trend is still clearly pointing upward. Now let's look at the dividend performance. FSMDX has a current dividend yield of 1.09%. Dividend growth has been weak with a 5-year dividend growth rate of negative 8.45%, which confirms that income is not the fund's main priority. Instead, most returns come from price movements supported by an average annual share price appreciation of 8.56%. This makes FSMDX a growth-oriented fund, where dividends play only a small supporting role. Now, let's look at what this means for John over time. If John invests $500,000 into FSMDX with no additional contributions, the projections show the following. After 1 year, the portfolio is valued at $548,250. Looking out further, it is projected at $1,194,710 after 10 years. At the 20-year mark, the portfolio is estimated to reach $2,737,261. And by year 30, it is projected to be valued at $6,230,671. Dividend income remains modest even over long periods. In year 30, annual dividends are projected at $281, which works out to about $23 per month. Across the full 30-year timeline, total value added is projected at $5,730,671, with $5,676,194 coming from capital appreciation and only $54,477 coming from dividend reinvestment. Look at benchmark funds like FXAIX. The underlying logic is pretty straightforward, but the numbers generated by 30 years of compounding are absolutely mind. In a long-term market like the US, your success doesn't really depend on guessing which single stock will pop. It depends on how you build your compounding engine. Because of that, I've put together a resource called the US Stock Compounding Playbook. It's a deep dive into the core logic of US assets and various compounding models to help you sharpen your strategy. I've already pinned it in the comments section, so you can click there to grab your copy. Fund number 4, Fidelity 500 Index Fund. Now, let's move up the list to number 4. The Fidelity 500 Index Fund with the ticker symbol FXAIX. This index fund tracks the performance of the S&P 500, giving investors exposure to the largest and most established U.S. companies. These businesses represent the core of the U.S. economy, including global leaders across technology, finance, healthcare, and consumer sectors. FXAIX is designed for long-term investors who want steady growth with broad diversification and low costs. FXAIX holds 507 companies, which provides solid diversification while still concentrating on market leaders. The top 10 holdings account for 40.1% of the portfolio, which means performance is meaningfully influenced by the largest companies. That is not a flaw, it is how market cap-weighted indexes work. The most valuable and successful businesses naturally carry more weight. Sector exposure reflects that structure. Technology makes up 36.87% of the portfolio, followed by financials at 12.58%. Consumer cyclical comes in at 10.66%, communication services at 10.38%, and healthcare at 8.96%. Industrials account for 7.4%, with smaller allocations to consumer defensive, energy, utilities, real estate, and basic materials. This mix allows FXAIX to benefit strongly during economic expansion, while still maintaining exposure across the broader market. Looking at performance, AVOSIX has delivered strong and consistent long-term growth. Over the last year, the fund gained 15.7%. Over 5 years, total growth was 87.66%. Over the longer 10-year period, FXAIX delivered a total return of 232.62%, clearly highlighting the strength of large-cap U.S. equities when held through full market cycles. Another major advantage of FXAIX is cost efficiency. The fund has an extremely low expense ratio of just 0.02%, meaning nearly all of the fund's returns stay in the investor's pocket. FXAIX follows a very stable long-term strategy with minimal trading activity. The turnover ratio is just 3%, which means the fund rarely makes changes. This low turnover helps reduce costs and keeps the strategy focused on long-term market growth rather than short-term moves. Currently, FXAIX is trading above its key moving averages, which signals strong momentum. Dividend income plays a supporting role here. FXAIX has a current dividend yield of 1.1%, and dividend growth has been steady, with a 5-year dividend growth rate of 4.93%. Average annual share price appreciation sits at 12.73%, which explains why capital growth does most of the heavy lifting. Now let's look at how this plays out for John. With an initial investment of $500,000, the projections show the following. The portfolio is valued at $569,150 after 1 year. Looking out 10 years, it is projected to reach $1,776,097. At the 20-year mark, the portfolio is estimated at $6,070,082. And after 30 years, it is projected to be valued at $20,398,411. Dividend income becomes more meaningful over time. In year 30, annual dividends are projected at $18,869, which works out to about $1,572 per month. Across the full 30-year period, total value added is projected at $19,898,411, with $19,565,670 coming from capital appreciation and $332,741 from dividend reinvestment. Fund number 3, Fidelity Zero, Total Market Index Fund. These numbers are great, but there are even better options to come as John moves up the ladder. In a couple of minutes, I'll show you which fund ends up paying John over $45,000 a month. And by the end, I'll show you one fund that can potentially turn John's $500,000 into a portfolio worth more than $47 million. But first, let's look at the third index fund on John's list. The Fidelity Zero Total Market Index Fund, also known as FZROX. This fund is designed to track the entire US stock market in one single fund. It includes large, mid, small, and microcap companies, which makes it one of the most complete own-everything options available. Instead of betting on a specific segment of the market, FZROX holds 2,553 companies, which gives it extremely broad diversification. Even with thousands of stocks inside, concentration is still reasonable. The top 10 holdings make up 35.25% of the portfolio. Large companies still matter, but performance isn't dependent on just a few names. Risk is spread across a wide base. Sector exposure closely mirrors the US economy itself. Technology leads at 35.09%, followed by financials at 12.76%, consumer cyclical at 10.65%, communication services at 9.66%, healthcare at 9.41%, and industrials at 8.64%. Smaller allocations go to energy, real estate, utilities, consumer defensive, and basic materials. This balance allows the fund to benefit from long-term economic growth without leaning too heavily on any single sector. From a performance standpoint, FCROX has delivered strong and consistent results. Over the last year, the fund gained 15.53%. Over 5 years, total growth reached 79.28%. Since its inception, the fund has shown a total return of 135.46%. One of the biggest advantages here is cost, or more accurately, the lack of it. FZROX has an expense ratio of 0%. That means none of your returns are lost to management fees. Over long periods of time, keeping every dollar invested gives compounding more room to work. Even compared to funds that already have very low costs, the strategy itself stays hands-off. The turnover ratio is just 3%, which means the fund rarely trades. That keeps costs down and allows returns to compound efficiently without unnecessary movement. FZROX is also trading above all key moving averages, which points to steady upward momentum. Dividends add another layer. FZROX has a current dividend yield of 1.01%, and dividend growth has been solid with a 5-year dividend growth rate of 7.19%. On the growth side, the fund benefits from strong price movements supported by an average annual share price appreciation of 14.42%. Together, that creates a balance where both growth and dividends contribute meaningfully over time. Now, let's look at how the projections play out for John with this fund. Starting with an initial investment of $500,000, the projections show the portfolio valued at $577,150 after 1 year. Looking ahead 10 years, it is projected to reach $2,500,615. At the 20-year mark, the portfolio is estimated at $8,130,124. And by year 30, it is projected to be valued at $31,721,312. Dividend income becomes more noticeable over time. In year 30, annual dividends are projected at $31,736, which works out to about $2,645 per month. Across the full 30-year period, total value added is projected at $31,221,312, with $30,774,872 coming from capital appreciation and $446,440 from dividend reinvestment. VS Rocks works well for investors who want maximum diversification, zero fees, and a simple way to capture the full power of the US stock market. It removes the need to choose sides and lets the entire system work on your behalf. And from here, the next fund starts to tilt the story in a slightly different direction, keeping broad exposure, but adding another layer that changes how returns show up over time. Fund number 2, Fidelity US Sustainability Index Fund. Taking up the number 2 spot is the Fidelity US Sustainability Index Fund, or FITLX for short. This index fund invests in large US companies that meet specific environmental, social, and governance, or ESG criteria. In simple terms, it focuses on businesses that are not only profitable, but also operate with long-term sustainability in mind. The goal isn't to sacrifice returns for principles, but to align both in a single strategy. FITLX holds 276 companies, which is fewer than the total market fund, but still provides solid diversification. What stands out here is concentration. The top 10 holdings account for 51.46% of the portfolio, which means performance is more heavily influenced by large, dominant companies. Much of that influence comes from technology and communication services, which help explain both the growth potential and the added volatility compared to broader funds. Sector allocation reflects this focus. Technology accounts for 39.23% of the portfolio, followed by communication services at 11.73%, financials at 11.19%, consumer cyclical at 9.99%, and healthcare at 9.76%. Industrials make up 7.48%, while smaller allocations are spread across consumer defensive, real estate, basic materials, energy, and utilities. This mix tilts the fund toward growth-oriented sectors while still maintaining exposure across the broader economy. Performance has been strong across all time frames. Over the last year, FITLX gained 16.57%, showing solid recent momentum. Over 5 years, the fund delivered a total return of 93.11%. Looking at the fund's full available history, total growth stands at 209.44%. These figures show that a sustainability-focused strategy has still captured strong long-term market growth. The fund's expense ratio is 0.11%, which is slightly higher than ultra-low-cost index funds, but still very competitive for a sustainability-focused strategy over long investment periods. This cost remains reasonable relative to the growth achieved. FITLX has a higher turnover compared to broad market index funds, with a turnover ratio of 9%. This reflects periodic rebalancing based on sustainability criteria rather than frequent trading. While this adds a bit more movement than traditional index funds, it still remains firmly long-term in nature. FITLX is trading above all major moving averages, which signals solid momentum. Dividends are where this fund really starts to separate itself. FITLX has a current dividend yield of 1.1%, and dividend growth has been unusually strong with a 5-year dividend growth rate of 15.42%. At the same time, average annual share price appreciation sits at 13.45%. Now, let's look at how the projections play out for John with this index fund. Starting with 50万美元, the model shows the portfolio sitting at $572,750 after the first year. As time does its thing, the value is projected to climb to $1,962,531 by year 10. And at the 20-year point, the portfolio is valued at $7,878,915. By year 30, it reaches $32,058,831. This is also where the income side really starts to show up for John. By year 30, annual dividends are projected at $545,680, which translates to roughly $45,473 each month. Over the full 30-year stretch, the total value added comes to $32,008,831. with $2,836,439, coming from price growth and $3,643,992 coming from reinvested dividends. Fund number 1, Fidelity NASDAQ Composite Index Fund. Now, let's move to the top index fund on the list that takes growth to another level. At number 1 on John's list, this is the Fidelity NASDAQ Composite Index Fund, also known as FNCM. It tracks the NASDAQ Composite Index. This part of the market is built entirely around growth, technology, innovation, and companies that are shaping how the economy works tomorrow: software, artificial intelligence, semiconductors, cloud computing, and digital platforms. This fund lives right at the center of all of it. That focus comes with trade-offs. FNCMX tends to move faster than broader market funds. Sector allocation reflects this focus. Technology accounts for 39.23% of the portfolio, followed by communication services at 11.73%, financials at 11.19%, consumer cyclical at 9.99%, and healthcare at 9.76%. Industrials make up 7.48%, while smaller allocations are spread across consumer defensive, real estate, basic materials, energy, and utilities. This mix tilts the fund toward growth-oriented sectors while still maintaining exposure across the broader economy. Performance has been strong across all time frames. Over the last year, FITLX gained 16.57%, showing solid recent momentum. Over 5 years, the fund delivered a total return of 93.11%. Looking at the fund's full available history, total growth stands at 209.44%. These figures show that a sustainability-focused strategy has still captured strong long-term market growth. The fund's expense ratio is 0.11%, which is slightly higher than ultra-low-cost index funds, but still very competitive for a sustainability-focused strategy over long investment periods. This cost remains reasonable relative to the growth achieved. Fitlex has a higher turnover compared to broad market index funds, with a turnover ratio of 9%. This reflects periodic rebalancing based on sustainability criteria, rather than frequent trading. While this adds a bit more movement than traditional index funds, it still remains firmly long-term in nature. Fitlex is trading above all major moving averages, which signals solid momentum. Dividends are where this fund really starts to separate itself. Fitlex has a current dividend yield of 1.1%, and dividend growth has been unusually strong, with a 5-year dividend growth rate of 15.42%. At the same time, average annual share price appreciation sits at 13.45%. Now, let's look at how the projections play out for John with this index fund. Starting with $50万美元, the model shows the portfolio sitting at $572,750 after the first year. As time does its thing, the value is projected to climb to $1,962,531 by year 10, and at the 20-year point, the portfolio is valued at $7,878,915. By year 30, it reaches $32,058,831. This is also where the income side really starts to show up for John. By year 30, annual dividends are projected at $545,680, which translates to roughly $45,473 each month. Over the full 30-year stretch, the total value added comes to $32,008,831, with $2,836,439 coming from price growth and $3,643,992 coming from reinvested dividends. Fund number 1, Fidelity Nasdaq Composite Index Fund. Now, let's move to the top index fund on the list. That takes growth to another level. At number 1 on John's list, this is the Fidelity Nasdaq Composite Index Fund, also known as FNCM. It tracks the Nasdaq Composite Index. This part of the market is built entirely around growth, technology, innovation, and companies that are shaping how the economy works tomorrow. Software, artificial intelligence, semiconductors, cloud computing, and digital platforms. This fund lives right at the center of all of it. That focus comes with trade-offs. FNCMX tends to move faster than broader market funds. When markets are strong, it usually pulls ahead. However, when markets pull back, it often drops harder. 2. John knows going in that this fund isn't about stability. It's about long-term upside. FNCMX holds 2,914 companies, which sounds diversified at first glance, but concentration tells the real story. The top 10 holdings make up 60.36% of the portfolio. That means results are driven by a relatively small group of massive technology companies rather than being evenly spread across all holdings. The sector breakdown makes that clear. Technology alone accounts for 53.15% of the fund. Communication services make up 15.71%. Consumer cyclical is at 13.89%, and healthcare at 5.39%. Financials, industrials, and the remaining sectors play much smaller roles. This structure explains why FNCMX has delivered powerful long-term growth and why volatility is part of the package. Performance numbers reflect that aggressive growth tilt. Over the last year, FNCMX gained 19.26%. Over 5 years, the fund delivered a total return of 86.26%. Over 10 years, returns reached 349.46%. These are the kinds of results that show up when growth cycles are strong, which it has been over the past decade or so. But they also come with sharper drawdowns when markets get stressed. Costs are higher than broad market index funds, but still reasonable for what you're getting. FNCMX has an expense ratio of 0.29%, which reflects its specialized exposure rather than inefficiency. Trading activity stays low. The turnover ratio is just 2%, meaning the fund sticks closely to its index and doesn't churn the portfolio. That helps keep costs and tax drag under control, even though price swings can be larger. FNCMX is trading well above its long-term trend levels. The price is 1.3% above the 10-day average, 1.77% above the 50-day average, and 14.2% above the 200-day average. Short-term volatility shows up, but the longer-term trend is still clearly pointing higher. Income isn't the goal here. FNCMX has a current dividend yield of 0.49%, and dividend growth has been negative, with a 5-year dividend growth rate of -4.88%. That confirms what John already expects. This fund is almost entirely about price appreciation, and that growth has been strong, supported by an average annual share price appreciation of 16.34%. Now let's look at what the projections show when John lets this index fund run with his $500,000. The model shows the portfolio valued at $584,200 after 1 year. Over time, the compounding accelerates. By year 10, the portfolio is projected at $2,313,322. At the 20-year mark, it reaches $10,525,966. And by year 30, the value expands to $47,821,177. Dividend income barely registers even after decades. In year 30, annual dividends are projected at just $24 or about $17 per month. Over the full period, total value added comes to $47,321,177. With $47,293,036 coming from capital appreciation and only $28,141 from dividend reinvestment. This is a pure growth play. It's volatile, it's concentrated. And for John, it's the fund that shows what long-term compounding can look like when growth is pushed to the extreme. Conclusion: these numbers are incredible, no doubt, but not everyone has $1 million to start with. There's actually an even easier way to reach a reasonable goal. Whether you're looking for broad market growth through FCROX and its zero-fee structure, or you want the explosive power that comes from the tech premium in FNCMX, it all comes down to one thing: precisely matching asset traits with time leverage. These kinds of results aren't just luck. They are a mathematical certainty driven by cost control, sector selection, and your holding period. I've turned all of this logic into a practical resource called the US Stock Compounding Playbook. Think of it as an operational roadmap for asset mapping. It breaks down different risk margins into modules to help you build a compounding engine that actually works for you. I've already pinned it in the comment section, so you can click there to grab your copy.